Beautiful. So we're talking about zebras and collars and stock replacement and how zebras are all encompassing. You can manipulate whatever stock trade you were trying to do. You can do it with a zebra for a much greater capital efficiency. And we'll dive into some visuals. We'll dive into some comparison tables, and it's going to be a great little 15 minutes here.
For sure. Especially when you consider that if you're doing this as a short-term trade, it's definitely a much more cost-effective way to get a very similar amount of delta. So for those that don't know, a call zebra is a long stock position with an embedded long put. You're doing this via options, and the net transaction, you're basically getting that long put for free or for zero extrinsic value. Typically, when you buy stock and buy a put, you're paying for that put. It costs you extrinsic value. It's an out of the money put, and that value is value that you won't be able to recoup, right? So if the stock goes down, you obviously lose money on the stock shares. And that extrinsic value goes to zero at expiration. So you're banking on intrinsic value. With the zebra, you have that embedded put in the position, and it costs you no extrinsic value because you're selling, an at the money call that offsets that extrinsic value that you're buying in the long put. So you get a temporary buffer on the position, like we said, with the stock and the long put. You're going to lose 1-to-1 to the downside. That put is going to kind of stop you out to the downside if the stock continues lower. With the zebra, you get a temporary loss buffer because of the increase in the extrinsic value of those long options and the decay of the short option that comes into play with the stock moving lower, right? So you're selling one call at the money, you're buying two that are in the money. If the stock were to go down towards the long strike, that short call loses value, which is a gain for you. And those long options, they're going to lose raw value, but they're going to increase in extrinsic value. And some of that increase in extrinsic value is going to offset the loss that you see in intrinsic value to the downside. But that position, that flips against you, right? So as time passes, that extrinsic value that you've gained on the downside starts to decrease, and you lose that value. So you do that buffer is certainly short term, and especially so if you're looking at this on like a weekly time frame, which is the examples we're going to get to here. So if you add a short call to the zebra, you turn this position into a collar trade. So typically with a collar, you own the stock previously, or if you're buying the stock now, you sell a call at the same value that you go and buy a put. You can get that same position with a zebra and the short call, but you're actually positive extrinsic value, because if you think back to what we were talking about with the zebra, it's a zero extrinsic value ratio spread. If you're selling that call, you're going to net have a positive extrinsic value net for the chat there. So you'll have the same risk profile as a long stock, long put, and a short call, but you're going to be getting that long put for free in the short term because you're net positive extrinsic value.
Mm-hmm. And just like a collar, a zebra with a short call is going to feel like a vertical spread, and that is going to be exemplified with the risk profile as well.
Yep. All right. So the first one we're looking at, this is zebra. We're looking at this on a 4-day time frame. We're putting this in the light of like a election trade or a CPI trade. You could do this to the downside as well. If you're looking for a short-term stock alternative, zebra is one of the ways that you can do that. So we're selling one right at the money, the 378. We're buying two in the money for net zero extrinsic value. There's tiny positive extrinsic value here, but you're basically doing this at a zero extrinsic value cost. Costs you about $1,500, and you can see your risk profile rather than just being a straight line down. You have a little bit of a buffer to the downside, and that's because of the change in extrinsic value that happens if the stock does move lower towards those long strikes. That buffer is short term. As you get closer to expiration, it's going to move closer to the at expiration line, which is that pink area there in the loss to the downside.
Yep. And this is one of the reasons that this trade is nice in terms of, if you're right, you get that static delta that's basically equivalent to the expiration risk graph, which is good for you. Mm-hmm. But if you're wrong directionally, you get that benefit of having this extrinsic value loss buffer, where if the stock comes down, your short call loses value, but your long calls lose intrinsic value, but they actually gain extrinsic value. So that explains why this little line here is not the same as the expiration graph, because prior to expiration, these long calls will still have extrinsic value, and that's going to prevent you from realizing losses in a pretty big way. This is a $1,500 trade in terms of the debit paid, but if you get a move right now to the long strikes, it's only a loss of about half that. So a nice little extrinsic value buffer. You have a lot of things going for you in this trade relative to against you, and that's why we like it a lot for short-term stock replacements.
Yeah, and that buffer, it's going to be much less so a buffer in the short duration trade, like a 4-day trade like this, because this will go to zero if it's out of the money at expiration on Friday. So when we talk about zebras on like a 40 or 50-day time frame, there's a lot more buffer built into that position because there's more time value on those options. It's going to be a more expensive trade, but if you are wrong on the direction, you have a lot more buffer. On a short duration trade, you have a lot less buffer just because you have 4 days to go till expiration. So it is important to realize that, this will start going more against you quickly. It really is a short-term trade, and you kind of have to be right on the direction.
Mm-hmm.
All right, so this is adding the short call onto the zebra, gives you the same risk profile that you would see at a vertical spread, which is the same profile you have with a collar position. If you were long the stock, short a call, long a put, it's going to look like a risk profile that you would see with a spread trade. You see the same thing here, but you are positive extrinsic value, which is why your downside break even point, and you can see this in the chart here, is skewed off of where the current stock prices, right? So that zebra, you do that for net zero extrinsic value. You're selling almost $3 in that call, that 385 call. That $3 of extrinsic value is your buffer to the downside. And so all else equal, if the stock stayed flat, you wouldn't lose any money. You'd actually make $3 because of that extrinsic value. If you were just long the stock, selling the call and selling the put and buying the put, for net zero cost, you wouldn't make anything. And that's one of the positives here, that you have added upside potential compared to a stock collar position.
Mm-hmm. And just like a vertical spread, what we're looking at here is this theoretical graph that is not very jagged. It's pretty smooth. So for you to realize max profit on this trade, or max loss, you'll need to have this trade go to expiration, where with the actual zebra by itself, the theoretical risk graph and the expiration graph when you're profitable is virtually the same, which is nice.
Yeah. Because those deltas stay pretty much static.
Mm-hmm.
And then here's the collar. So you can see the risk profile is basically the same as that zebra and added short call position, but you don't have that same extrinsic value buffer. And you can see here, just because of the difference in prices, I wanted to use the same strikes here. You're buying a small amount of extrinsic value here, but on the zebra with the short call, you're selling $3 and change in extrinsic value, and that's value that's reducing your break, or is moving your break even further to the downside, giving you the potential to profit more on an upside move, and give you the potential to profit if the stock doesn't do anything. Here, if the stock doesn't do anything, you lose your hedge. You lose the value of the long put that you're buying. That short call goes to zero. It offsets, and you're flat the position. With the zebra and the added short call, you have this same risk profile, but with an added profit potential, just because you're selling $3 of extrinsic value there.
Mm-hmm. And with the zebra and the short call relative to the collar, you'll because you have that buffer, you'll have a little bit more of a max profit, a little bit more of a max loss. But that's the decision to make. Do you want that, or are you just trying to temporarily hedge the shares that you might already own?
Yeah. This is more of in the context of like wanting to take a directional shot this week. This is less so applicable to somebody that's holding long shares of SPY or long shares of Apple, because you're probably at a way different cost basis than what we're looking at now. It might be higher, it might be lower, so that's going to factor into your decisions. This is more of like, if you want to take a shot into this week, here are two alternatives that are much more capital efficient than just using stock. For those of you that are in IRAs or cash accounts, here's, $2,000 that you can, that will give you 100 shares of SPY or more. All right. So here's our table here. Lots of colors. I thought long and hard on how to color these. Mikey assured me that this worked. So if it doesn't work for you, you can blame him. But the red and green here just kind of indicates a preference of like good versus not good in my opinion here. So the first set we're looking at is a long stock in the Zebra. You can see your buying power and your cost. For the Zebra, $1,500. That's all it costs you to put that on. You get that same 100 delta or very near 100 deltas. If you're in a margin account, buying shares of SPY going to cost you about 50% of the notional value, which is about 18 grand in buying power. If you're in an IRA or a cash account, you're going to be paying the full notional value, 37 grand. That's a big position to put on with, for a 1 week trade here. Obviously, max loss to the downside in SPY is if it goes to zero. That's probably not realistic, or let's say we probably have a lot worse problems to worry about if that did happen. But you obviously have the capped loss on the Zebra via that debit that you're paid, so that's a positive for you there. Max profit, both of these have unlimited profit to the upside, so you have the same mark there. When you get into the Zebra, though, the one thing that you have to consider is that the change in extrinsic value, it's going to take a little bit of value off your upside potential. So when you have 100 shares of SPY, it's going to move 1-to-1. The P&L is going to move 1-to-1 via the movements in SPY. The Zebra, you're going to have changes in that extrinsic value where if you're right on the direction, your short option is going to hold extrinsic value. The long option is going to lose extrinsic value. So you're going to net have a little bit lesser upside, but it comes with a little bit lesser of a downside in the short term. And if you get that move, towards the 370 strike, with your SPY shares, you're going to lose the $700 right off the bat. But with the Zebra, you have about a 10% buffer there in the short term because that extrinsic value is going to increase in the longs. Your short's going to go to zero. The problem is that as you hold this position, it will get to a bigger loss point than if you had shares at the 370 mark. Of course, if it continues lower and we see a crash situation where we go to 3,000 or something like that, you're going to lose that 1-to-1 to the downside, where the Zebra is defined risk to the downside. So it's important to note, if you get a move down, in this case, to like 372 or 370, as time passes, and we're on a weekly time frame here, you're going to see more losses than you would with the stock. So it's kind of a risk reward that kind of skews against you the more you hold this position.
Yep. And really, when it comes to Zebra versus long stock, the only situation where we would go with long stock is if we plan to hold it for more than a year. Really, like there's just no way, there's no reason, in my opinion, if you're using a short-term trade, to go with long stock when you can use a Zebra instead and really protect yourself against big moves, especially for a CPI report, something like that, where your assumption could be bullish, your assumption could be bearish, but you could see the market move 100 points in either direction. So this Zebra really saves you from taking big losses on a position. But if you're correct, like we showed earlier, you're going to get the same P&L as long stock or short stock. You just have that protection in place, which can come in handy, especially when the market is moving aggressively.
Yeah. All right, then the collar and the zebra covered call position. So of course, with the collar, going to cost you the same 18 grand because you're long the stock. The zebra covered call is going to actually be a lesser debit because you're selling extrinsic value to $3 in extrinsic value on the zebra covered call, which makes it a cheaper debit than just the zebra alone. Of course, your max loss, it's going to be greater on the zebra covered call. It's that debit that you're paid. And again, that's because in the short term, you're going to have the same kind of buffered loss risk profile. But as time passes on this short duration trade, it is going to increase past what you could lose on the collar type trades. The collar defined risk, you have $7 of downside. You have the $8 of upside. With the zebra cover call, though, you have that higher upside because you're selling $2-3 of extrinsic value on the upside. That's going to give you more value that you can capture on this position if it does go in the money. And you can see that reflected in the upside profit potential. If you get that move to your short strike, you're going to make the full intrinsic value that you would with the stock position, plus that added $2 or $3 of extrinsic value. So you have a greater profit potential to the upside. Conversely, on the downside, you have that same amount of risk, especially in the short term, because of that change in extrinsic value. So if you get that move to the downside, you do have more notional risk at 370 because that debit is going to go to zero. But in the short term, you're going to have that pop in extrinsic value, which is going to buffer you and give you a very similar downside risk as you would with a collar type trade.
Mm-hmm. So yeah, big takeaways here. Using options to synthesize stock, you're going to get a better efficiency in terms of capital outlay. Some situations might land you with a slightly greater than max loss if you literally pin your long strikes where your options are just out of the money. But in all these other scenarios where you get a really big move against you, the zebra, especially the zebra versus the long stock, it can protect you in a big way. In the shorter term, the zebra is the lower cost it's going to be. But of course, the closer you are to the stock price, which means the closer you are to your max loss threshold, and the longer term a zebra is, the more it's just a long stock position, where a lot of these potential capital efficiency benefits kind of get nullified.